Joining us now, we've got Chris Versace, Chief Investment Officer, Tematica Research. Chris, thank you so much for joining us today. We've got a couple earnings to dive into, but whenever we have you here, we always like to get your big picture thoughts, whether it's about the Fed or tariffs. But let's dive into a couple of the earnings. Shopify under some pressure in the pre-market. Looks like mixed numbers here. They missed on adjusted EPS, 25 cents a share. Street was looking for 26 cents. Sales topped $2.3 billion. That was better than expected, but they're projecting lower sales in this current. Well, their projection for sales looks like it's essentially just in line with the expectations, but it looks like there will be some pressure from tariffs. What is your overall view?
So, in this environment, you really have to deliver better than expected news. You can't have any chinks in the armor, right? So if you've got a good top line and you miss on the bottom line, your stock's going to get hit. But parsing through the results, I think there's going to be big questions on the earnings call this morning about margin pressure, right? So you can forecast faster revenue growth, that's great, but if you're not seeing your profit dollars keep up, that signals margin pressure. That likely means negative revisions to earnings expectations. But we'll learn more on the call.
Obviously, yeah, and then sometimes we can see things change direction during a call, especially if they are able to talk up the numbers in some kind of way.
Correct.
And let me ask you, do you think that the trade war will continue to affect a company like Shopify, given that, okay, we're seeing some movement in terms of trade with the U.S. and U.K., but we don't have all the answers yet.
No, and I think that's the big point, right? We might see tariffs come down, right? This first trade deal, maybe it's the blueprint for what we'll start to see, so we'll really have to pore over it carefully. Maybe it's setting the framework for what we could see happen with the U.S. and China in their upcoming trade talks. But more likely than not, this is a de-escalation, not a wipeout of the Trump tariffs, but who knows what those numbers are going to be. So I think until we start to see more trade deals and see where these numbers are lining up, management teams, they're going to have to err on the conservative side. Okay,
and that makes sense. And I mean, because so far during this earnings season, we've seen a few different ways that companies are guiding, right? There was initially the theme of we're just not going to give guidance throughout this year, or for the balance of the year because we don't have clarity. There's those who were actually giving two different scenarios.
United, for example. Yeah,
exactly.
Yeah.
The best of times, the worst of times scenario.
Right.
And then there are those who actually, maintain guidance, and that kind of became the new beat and raise theme this cycle. I'm curious to know your thoughts on Dutch Bros. Shares moving a little bit higher right now in the pre-market off the back of their earnings. They reported 13 cents a share. It looks like people are still getting their coffee.
I would say so. So Dutch Bros to me is a classic geographic expansion story. In this case, west to east. We've seen it many, many times before. Starbucks is probably one of the best examples, but there are others out there. And what did they do last night? They do what they do. They delivered. And they reiterated their guidance, as you said, maybe the new beat and raise. And I think that they reaffirmed their expansion plans, not just for this year, but their longer-term expansion plans. The testing on food is on track. That should expand in 2026, giving another layer of growth. So I would say that the Dutch Bros story is, as expected, tracking well, but it also didn't signal that people are pulling back.
Okay, well, that's certainly a good sign when you think about the strength of the consumer. Let me ask you this. The Fed held steady on rates.
Yeah, I saw
between
that.
4.25% and 4.5%, right? That was as expected, right?
Of course it was.
But some people are angry about it, including President Trump, who said too late. And we had a guest earlier who seemed to share some similar views. But the Fed has always sent that message that, it's data dependent and the data doesn't, cause the Fed to move on rates now. What's your thought on the comment about too late, or those who think the Fed is behind the curve?
I don't think they are at all. The question is, how many rate cuts will we get this year? And the market's expecting, ahead of the Fed meeting, about 3, earlier in the week, maybe 4. We very well may not see that many cuts. To me, the June policy meeting is the most important one. That's where we get the updated SEP. But if you look at what we saw in the latest employment report, still chugging along, but you look at what we saw in the ISM April data, particularly on the pricing front, escalating prices, and that's just the start of what we're seeing with tariffs. Remember too, this week we're going to start seeing the impact of falling port volumes. That's going to be inflationary. Companies, consumer product companies are talking about raising prices.
Right.
So there's potentially more inflation in the pipeline, and I think the Fed sees that, and they're saying we need to really understand how all of this is playing out. I don't think it's a bad move to wait.
Do you think by the June meeting there's enough data to support essentially like a rate cut? There will be essentially 6 weeks of data by that time.
That is true, and I think that, I'm really looking forward to the May CPI data, the May ISM data, because it'll tell us a lot more. But, like you mentioned, a few minutes ago, we're starting to see some thawing on trade deals, so a lot can change.
And then what's your expectation when you think about, obviously we're clearly going to get some kind of framework today. About 10 a.m. Eastern is when the president will roll out what the deal looks like between the U.S. and UK. We also know on Saturday, the Treasury Secretary and the trade rep are headed to Switzerland to begin what appears to be official talks with their Chinese counterparts for a trade deal there. The expectation is that's going to take longer. What are you looking to hear from that?
I expect to see maybe some nice headlines, probably a little light on details, especially with China coming out of the gate. I think it's going to be more important for the administration to line up, more deals like the UK to kind of push things along and help them really set their agenda for what they ultimately want to get out of China.
Does how the market is pricing this now, does it all make sense right now? We've regained some momentum, especially when you think about that volatility that we had just a month ago.
Yeah, I mean, the market's had, fits and starts of what I call hopium, right? So expectations can get ahead of themselves. And is there the possibility there might be some of that as we start to see some early trade deals being announced or early terms being leaked? These things, they're not necessarily going to be fully hammered out, I don't think. But ultimately, it's what happens with the U.S. and China. That's going to be the biggest one.
Okay, Chris, thank you. You always bring great perspective. Appreciate your time.
Anytime.
That's Chris Versace, Chief Investment Officer to Monica Research. Our thanks to Chris.